Well, I am super excited today to jump into this panel on raising VC funding. We've got a wonderful panel here today. For some quick introductions, I am Wade Fletcher. I am a third-year undergrad in Bloomington, Indiana, in the U.S. I am also the managing director of Undercover VC. We're a network of students advancing student founders in campuses that historically haven't gotten the attention we think they deserve. We've got an amazing panel here today, and I'm super excited to turn it over to them and ask them to introduce themselves. Millie, if you can start us off.
Absolutely, Wade. Thank you so much for having me. It's great to be here. So yeah, hi everyone. I'm Millie. I am brand and communications manager and a partner at Bethnal Green Ventures. We are Europe's leading early stage tech for good VC firm. So we have pioneered tech for good in the UK and Europe since 2012, and we invest at a really, really early stage. And are often startups sort of first investors, and we grow with them from there. So yeah, excited to be here and share some insights.
Awesome. Thank you, Millie. Cleo?
Hi, everyone. Thanks for having me. Excited to be here. I'm Cleo, partner at Stride, based in London. We invest in pre-seed to Series A startups across Europe. With UK as core, and our check sizes range from 250K to 5 million. We like to be very operator-minded and hands-on when it comes to helping founders in our portfolio. And yeah, very excited to be here. And as previously an operator, CEO at Spotter Home, and spent 4.5 years building Uber China and Uber EMEA as well.
Awesome. Ivan?
Yeah, thank you so much for having me here today. I'm Ivan. I'm from Barcelona, and I'm the managing partner at Enzo Ventures. We are a community-based fund from Barcelona, investing across Europe, the very beginning stages of tech startups. We have been investing in 9 companies so far, from checks up to 50K. Right now, we're raising a bigger fund to increase our tickets from 100K to 500K. And we'll be able to also keep going with our operational mindset. So thank you so much for having me here. And yeah, very excited.
Wonderful. Thanks, Ivan. And rounding us out, Jamie?
Hi, I'm Jamie MacFarlane. I think I shop at the same place as Millie. I am the CEO of Creator Fund. We invest in university startups, so primarily PhD students, academics as well, investing in the deep tech and AI space. We do that by having teams across 28 universities across Europe on the ground, finding innovation first. We've invested in 13 companies to date, backed by Founders Factory, Eric Schmidt through Schmidt Futures, and a group of 50 investors.
Wonderful. Awesome. Well, we'll jump right into it. Again, for the audience, our topic today is raising VC funding. And one early piece of advice I got was to pay more attention to startup failures than successes, because every unicorn has a unique story, but a lot of startups fail for the same set of reasons. And so kind of looking at that through the angle of fundraising, and this is open to anyone, please jump in. What's a common mistake you see and common pitfall you see in fundraising that founders should look out for?
I can jump in.
Please do.
Yeah, so I think I often kind of observe, lots of our companies sort of, so we're often their first investor, and then the next stage is often kind of they're looking at angel money and maybe sort of some pre-seed VC funds. And I often find some founders fall into this kind of pitfall of thinking that they should be building their product or service sort of for the VCs that they're trying to pitch to. And trying to like tell their story and almost build their business with sort of VCs and investors in their mind as their audience, which is just really not kind of the right way to be going about it. Because obviously, although you need to be able to pitch your kind of your business and your story to an investor audience, actually what investors want to be seeing is that you're sort of laser focused on your users, your customers, and that you're building the business for them. So I think you know, it's understanding that yes, investors are your audience, but they shouldn't be sort of who you're trying to build that business for, particularly at those early stages. It really should be your users that you're focusing on.
I can jump in here as well. Totally agree with Millie in terms of what we've seen as well. And I guess besides that, some founders may be drawn to certain investor sort of brand names, or you know, going with optimizing for valuation. I think the fundamental mistake here is probably just going with the wrong investor, rather than focusing on a person, like the right partner at the right firm who can actually be a person you can work with for many years, because we like to look at it as a very long-term partnership and a really long-term relationship. And sometimes founders, you know, they might not be careful in doing founder references. You know, for example, we'd always recommend speaking with founders that the fund has backed in the past, be it founders who have done super well or founders who have struggled, and just being very careful and selecting your partner. I think that's probably the most important thing. And then a couple of other smaller things we've seen are maybe, you know, either raising too much for the stage of development. It could sometimes just be pre-product, be like a deck with an idea, and then the team could kind of struggle to explain why they're raising a very big round relative to where they are, or raising too little, and leading to, you know, them potentially having to make trade-offs around, for example, the talent quality after, which is never a good sort of trade-off to have to make. So those are sort of the first common mistakes that come to mind.
Definitely, yeah, 100% agree with Cleo. I mean, from my point of view, I think that the operational value that a VC can offer to the founder team is just key. I think that one of the common mistakes should be just going with some VC partners that cannot give this operational value. And yeah, we're very, very aligned on that part, and also trying to just get little checks, kind of go for the product market fit at the very beginning. I think that makes a lot of sense as well.
I'd say the biggest mistake I see is around kind of hype and creating a sense of momentum. So kind of the most important thing in raising your round is making this feel like an exciting round that people are struggling to get into, and there's a lot of movement and excitement around what you're doing. And I see kind of the mistake in two directions. The first of which is it's kind of, especially student founders, kind of pretty artificially fabricating that excitement. So saying things like, you know, the round's closing within a week, or I'm trying to have all my conversations the next 2 weeks, or, you know, only willing to get, you know, speak for 20 minutes and want to speak to general partner, trying to create that sense of everyone's trying to get a slice of my time when it's kind of transparently not the case. So we see quite a lot of kind of entrepreneurs doing that. But then at the other end of the extreme, you know, we back a lot of PhD founders, a lot of deep tech founders that don't really know how to sell. So they've got something quite special. They're doing something really interesting. They take way too long to respond to VCs. They're not ruthless enough. They kind of allow a lot of people to kind of hover around a deal without dropping a term sheet. So we see people kind of making that mistake at either end. And actually, in my view, kind of having a lot of conversations with people not willing to lead your round is not particularly constructive, especially in the first kind of few weeks, months of the fundraise. Really what we see a lot is that kind of need to get somebody who's willing to come in, price it, lead it, and then other people will follow. So my advice to someone raising would be kind of focus on that first. Who can you target to lead this? Create some competitive pressure. That's how valuations go up. And then worry about who's going to fill out the rest later.
Awesome. Well, thanks everybody. I do want to mention we do have the Q&A open. So if you'd like to ask a question to our panel, please drop it there, and I'll be keeping an eye on that. But something that Jamie and Cleo, you both mentioned, was valuation, and that's something I wanted to touch on in this conversation, because I think that's a big question for a lot of early stage founders. You know, you hear a lot when you're super early, oh, you know, we want the lead to set the terms, or, you know, and kind of punt on that. But how do y'all think early stage founders should be thinking about valuation when they're going to take that first check, and setting themselves up for success going forward?
So I can contribute on this first. So I think the biggest mistake that people make is thinking about valuation rather than dilution. So the vanity metric of I'm raising at a £5 million valuation or £10 million valuation is actually fairly meaningless, right? Like I could create a unicorn tomorrow by investing £1 in a company and giving them £1 billion valuation. Like the key question is dilution. Like how much of your company are you giving away? And so that equation of money going in divided by post-money valuation. Typically in the UK right now, coming out of universities, if you think about a pre-seed round, so let's call that something like 500K, you would expect dilution if things go amazingly to be 15%. If things go somewhere average between 15 and 25%. And if things go a little less great, maybe 27, 28%. And if things really don't go great, 30% plus. And I think really you kind of want to think about where are you in that continuum? And obviously valuation matters, but that percentage for me is the key number.
Yeah, and I would always look at it as sort of how much money do you need to get to your next big milestone. So it could be 18 or 24 months from after you close this round. What do you need the funds for? Be it key hires or tech or whatever, or infrastructure, and then how do you plan to use the proceeds? I think having a really kind of robust explanation around that and a clear set of priorities going into fundraising is important, and then having that, triangulating that number with the dilution that Jamie just mentioned, right? You're like, okay, maybe I need, I don't know, 2 million in the next 18 months and I'm willing to dilute, say 20%, and then that then you back out the valuation from there. I think that's probably a sensible approach that we normally see. And then also, I mean, there's then deal dynamics that could impact the valuation from that point, right? If you're managing to drum up a lot of hype for your round, and lots of investors are interested, people are willing to maybe offer you more money or bid up the price a bit, then that could happen. But then in terms of initially anchoring how much you raise at what valuation, I would probably always first go back to sort of runway and use of proceeds.
Awesome. Well, Jamie, I want to jump back to something you said, and that was talking about kind of it being very transparent sometimes when founders try to artificially create that FOMO. I want to open up to all of you. What are some kind of solid, legitimate strategies to create that FOMO and to get the best terms on that? I mean, obviously the easy answer is start a great company and do something really cool, but are there strategies founders can use to create that FOMO in a real way?
The most obvious first one, I mean, I hate to talk about tricks, so I always just think about the profile of the founders to begin with. Like, what do they do before? What have they built? Where did they come from? And what's their reputation like, right? Based on people who've worked with them or backed them before. I think that's always, a main source of hype when it comes to an exciting founding team, when various funds look at them.
I think one good tip, I don't think it's engineering from it, but never send a chaser email that's like, hey, how things are going? What are the next steps? Always send a chaser email with a new piece of news. So it's not like, hey, haven't heard from you since our pitch. Like, can we have a follow-up call? It's like, hey, since we've last spoken, we've got 100 new users. Or, hey, since we've last spoken, that we've signed on another investor or whatever it is, or we've hired a great COO. Like, come with new news every single time you're reaching out to an investor, so it feels like there's progress over the course of the round. Because actually, that's something that's quite important, right? If you're raising a round over 2 months, things should be moving for you as well during that time. So that's not engineering it, but something that I would always do if I was following up with investors.
Yeah, I'd agree on that in terms of we encourage all of our companies to really start building those relationships with investors before they're trying to raise from them, and actually have kind of a rhythm of updating people, whether that's investors or potential partners, on kind of the process, on the progress that they're making. And I think I would also say on the other side of things, to be honest, it depends what sort of investor you want, because if someone was kind of, being too hypey and too pushy, like, actually most investors will sort of see through that. So I think it's really about finding that it's a fine line. and ultimately it's you know, it's relationship building. So I think, you know, obviously you know, there's a sell element, but there's also just an element of like building a relationship, because, you know, if that investor's investing, then that needs to be, you know, on the basis of like a solid relationship, not just kind of like, oh, we managed to sell you this and now like they're gonna, you know, see through it if it's just hype.
Definitely. I think it's very, very important to create this kind of long-term relationship with later stage funds. We try to kind of create workshops at some point. We're doing this with Co-Founders Capital from Enzo, and just to try to kind of clarify or give a little more visibility on what's next to our portfolio, right? So it's basically pitch workshops, how to perfection, how to just clarify and try to think what are the milestones to achieve the next round. I think that's a very, very important part.
Awesome. So shifting gears a little bit, as the industry evolves, you know, we start to see new things like PIPE and equity crowdfunding starting to take a tiny chunk out of the venture market. Is that something y'all feel pressure from, or do you still very much have plenty of room to operate?
I think, to be honest, I think it's an exciting time in the industry in terms of more innovation from VCs themselves, in terms of, you know, shaking up the traditional model. And, you know, we've seen sort of, you know, revenue-based sort of VC funding kind of approaches, like, yeah, increasing crowdfunding. I think my personal opinion is it's a good thing. I think, you know, I think we need, you know, VCs need to take a leaf out of the, you know, the companies that they back's book, and be a bit more innovative and open-minded. And, you know, I think, I think it's no bad thing.
Yeah, same here. I think all these options and different structures are really great for founders in order for them to find the right solution that best fits you know, their funding needs at a given point in time. I think if you think about pipes or equity crowdfunding and traditional VC funding, we're all sort of complementary to each other, right? For example, pipes are really great for late stage private rounds for companies that are, you know, going public via SPACs, or, you know, that are looking for long-term capital after they go public. Equity crowdfunding is great, I think, for consumer focused startups that are looking for more participation from their customer base or to get feedback that way. And then early stage VCs, you know, like us, are still different from both of those, because we sort of step in as partners in the early years, and we're there for, I don't know, 7-10 years to help the founders really build and work through the strategic questions. You know, over that course, that stage, you know, that is quite critical for the companies. And so yeah, it's great for founders. And I also really like the idea of like revenue-based financing or debt financing. You know, those options being available are also great for founders, in that you know, they can avoid excessive dilution in the case of, you know, more like capital intensive business models. So I think it's a really exciting time for the industry.
Awesome. Anything to add, Ivan or Jamie?
Not really. I think it's well, it's clear. I think it's very, very interesting, and we're kind of in a wait and see kind of situation in Enzo Ventures. But yeah, more than open to try to think this methods, and yeah, we'll keep an eye on it, definitely.
Awesome. Well, I think we'd be remiss if when talking about fundraising, if we didn't talk about what you're investing in now. So I'd love to go around and learn about the most recent addition to each of your portfolios. If we want to, I guess we can start with whoever wants to go first.
I can go first. We just invested in a company out of Imperial University called Cogitat. They read brainwaves and turn brainwaves into something that can control machines. So it makes sense of what the brain's able to think, and therefore you could play a video game only through thinking, or if you are disabled or has prosthetic limbs or paraplegic, your brain can control medical devices without using hands or legs. And it's a team of 4 neuroscientists at that university and a plastic surgeon. who reconstructed faces after trauma, and so had the insight if he could get facial muscles moving again after trauma, he could do the same for machines. And for us, why we love a business like that is it's what university founders should be creating and winning, right? In our view, we're looking for businesses where because the founding team have got that expertise or that innovation and they're using the resources around them, they've got an unfair advantage in winning in that space. So we don't typically invest in kind of normal B2C businesses coming out of universities, because in our view that doesn't quite have the same edge as a founder with deep domain expertise building a company in that space. And so that's the most recent investment from Creator Fund.
I can share one as well. We recently invested in a company called Hoffy, based in the UK. They are building an end-to-end platform for companies to equip their remote workers. So electronics and laptops or furniture like ergonomic chairs, and providing the management tools, like lifecycle management of these pieces of assets, tracking the assets and compliance software as well. As we all know, remote work has really become a huge wave, especially with COVID, but even before COVID, right? And the software and employment side of it is already quite well addressed with big companies like Remote.com or Oyster. But there isn't, at least when we invested, there hasn't yet been one big player that's really tackling the equipment space very well yet. And so, and then there's a new wave of obviously like software tools that are also helping, like Slack, Zoom, Hopin, obviously. So for companies to really be able to equip their teams properly, we're really excited to back Hoffy. And it's also quite complicated, right? It's a full stack model, quite capital intensive, but we think if the team is really strong and able to crack the supply chain side of things and really build it, then it could be quite defensible as well. So we're quite excited about this one.
Definitely. Well, actually, our last investment is Bank Fleet. It's a technology for bank portability that allows the user to change all their recurrent source of income just by clicking on their bank account, and just to give the user all their power on their data and democratize the way people is just managing their own fintech data, basically, right? So their own they are kind of gaining power in that sense. And yeah, we have Coinbase with Notion Capital here. It's a very, very early stage company, but yeah, we're really very excited about that one.
Yeah, I can go. We invest in sort of about 20 to 25 new companies a year, so it's always really hard to choose. But one of our portfolio companies that's doing really exciting things at the moment is an app called Spoke, and essentially they identified the fact that so young men are radically kind of disproportionately represented in suicide rate. So 85% of suicides in the UK and the US are young men. Yet the sort of mental health wellness industry just completely overlooks this kind of segment of the market. So they have created an app called Spoke, which is sort of a culturally relevant kind of next gen mindfulness app. And they work with amazing sort of musicians and artists. They're potentially going to be working with sort of Jay-Z's label, and they're sort of kind of really challenging this category, and that's something that we get really excited about, sort of underserved and overlooked markets and users.
Awesome. Well, I want to extend another invitation to our audience to ask any questions you have in that Q&A. I would love to bring those to our panel. But in the meantime, Millie, you mentioned those underserved and underaddressed markets. I would love to know what an example of a market each of you sees that that maybe is not in the typical underserved markets. Somewhere you see that might have an edge going into the next decade.
Yeah, I can go. So I think there's an area that we invest into called worker tech. that we're very excited by. And this is essentially looking at tech that can support low paid, low income sort of frontline workers. And, you know, this was the pandemic just sort of, you know, shone a light on this, that many people sort of weren't, you know, didn't fully appreciate the scale of both the problem and the opportunity here. And I think increasingly as people sort of, you know, move towards gig economy work, and where previously unions would have acted in the interests of those workers to protect them and their rights, you know, they're just not really working for particularly younger generations now. They're not appealing. So there's some really exciting companies we've invested into that are specifically targeting those workers, and I think that's something that's only going to grow, you know, the sort of the future of work and the future of precarious work, and that's something we're really excited by.
For us, we're non-thematic, so we look quite broadly. And in the early stages, I think it's also quite hard to be very top-down about themes, because I think great innovation, great ideas can come from really anywhere. But we've been looking at a number of areas. There are a few areas that are like AI, ML powered, right? With the advent of GPT-3, or like companies that are tackling, say, automation. Besides, you know, RPA, there's also like cognitive process automation, which could be very interesting and a really big opportunity. There's also, as Millie mentioned, I think consumer healthcare, you know, seeing quite a few in the fertility space or in the mental health space, which are obviously big areas that actually companies are looking to increasingly help their employees with. And then within the spaces of, say, fintech, you know, there's still pieces of the market that are quite antiquated. For example, in insurance, it's still quite a difficult process to shop for insurance. So insurtech remains interesting. And then, I think similar to what Millie mentioned, future of work, gig economy type of companies. We're investors in Collective Benefits, which is a company that provides, you know, social sort of safety net insurance and other benefits to gig workers. So helping employers provide those benefits for gig workers to enable more independent work. So those are some areas that I find quite exciting.
Yeah, I can go. Definitely, we are kind of in a transition period. So we are from one fund to another one, and we are trying to identify which areas, which sectors will be the most, the hottest one in order to invest in. And we have identified kind of tech kind of interests and sub industries in that sense. I think that personally, I believe that kind of health tech, or fertility tech, mental health, and also telehealth is very, very, very hot and very interesting to invest in the following years. And I mean that would be my kind of industry and sub industries that I would if I had to decide, I would say that one.
We've done quite a lot of investing around robotics. So as you need to take human beings out of human processes accelerated by COVID, how can machines take over activities that were previously done by humans? It's also why over a number of years we're pretty bullish on the drone space as well. And then similarly to Ivan, we invest a lot in kind of data as improving drug discovery, health processes, health outcomes. We invest in a team out of Oxford in March that are developing mutation-proof vaccines using data, and so allowing vaccines to know how a virus is going to mutate, and then they can be prepared in advance. That company's done really well, and so again, it's where we see kind of universities most likely to create a winner, especially as we see multidisciplinary teams of maybe medics or life scientists coming together with computer scientists. Awesome.
Amazing. Well, those sound like great industries that I hope our audience will want to look more into. I'm going to make one last reminder, then I'll give it a rest, that the Q&A is open. So if you've got, we've got something. Okay, awesome. So first question, looks like we might have lost somebody. First question, how can student founders who don't have a PhD demonstrate their capability to venture capitalists?
I can take this. This is that's a really good question. I actually can't see the questions and answers, so if there's a follow-up, let me know. But really good question. The key thing, right? Again, the second kind of continuum of the day. I think at one end in the university landscape, you have like, for want of a better way of saying it, like 65-year-old professor that has to be kind of dragged from the laboratory to spend 1 day a week consulting at a company. And that's typically like the kind of heavy duty IP deals that have got funded in the past. And then at the other, you've got like 20-year-old founder that already calls themselves a serial founder because they've done 5 startups, each of which have folded, and they kind of dream of being like on the front cover of TechCrunch, right? That's like the extremes. And for us, it's the sweet spot of like super motivated person who at the same time has some sort of expertise of what they're doing. And to the question there is, if you're an undergraduate or master's or potentially not got the PhD deep domain expertise, how do you do that? The answer to that is like genuinely, absolutely demonstrating that what you're building, this problem, is what keeps you up at night, what you think about over your breakfast in the morning, what you think about over the weekend. The biggest kind of thing that we're allergic to at Creator Fund is I'm going to tackle pensions on a Monday, vitamins on a Tuesday, and then I'm going to open a gym on a Wednesday. Like, why are you doing this for the next 10 years, building this company? It doesn't necessarily have to be because you've got a PhD in it, but it might be because you've had a family member that's been affected by this, or you dream of working in this industry, but you know this industry needs to change, or you've experienced firsthand how you've gone and done something. That for me is critical. So just to give an example, and I know Edventures originally started at Edinburgh, but it's gone beyond, but we're very, very bullish on Scotland at Creator Fund. We invested in this guy, Heriot Watt, 22 years old, from the north tip of Scotland. He was going to be a professional boxer, broke his leg, his dreams of boxing smashed, and he was sitting on a bench day in, day out, trying to do minute leg exercises to try and get his leg strength back, and realized that actually there was a AI-driven way to rehabilitate his leg in a much better way. And now he's built a product that's being used by the Scotland rugby team, Manchester United, all across the world. We want that, right? A tangible and genuine articulation of how you're obsessed with this problem. That doesn't have to come from a PhD, but it can't be that you're going to exchange that for something else the next day.
Yeah, I'd absolutely echo what Jamie said. And I think, historically, there's been a real diversity issue in the VC industry, and the founders that are getting backed, there still is. I think it's a huge opportunity for investors that are backing people who aren't necessarily that typical sort of idea of what a founder is. So from our point of view, you absolutely do not need a PhD to be a founder or to have domain expertise. And as Jamie said, lived experiences can be just as, if not more, kind of compelling in terms of the reason why someone set up a business to solve that problem. Absolutely, like, just go and get your hands dirty, because being a founder is about actually just doing. And so you might have all the expertise in the world, but if you can't just get out there and start building and talking to your users and testing and iterating, then it's really not worth much. Lived experiences, getting your hands dirty, that's it's as compelling as any other kind of education.
Awesome. I'm going to paraphrase this question a little bit, but we'll go word for word. What are your thoughts on ML and crypto? Do you fear a bubble in the space, given that every day there's a startup that uses AI for X or decentralizes Y?
I can just briefly sort of contribute on that. I think there's sort of, we've been investing for kind of 10 years, and it's quite funny I've been with BGV for 3, and just even in those 3 years, it's really interesting to see the sort of the various applications come in and sort of, almost playing like buzzword bingo in terms of like, there's this new technology and suddenly it's, everyone wants to call it, tech like AI, but it isn't even AI. So I think what I would say is that like if you're using a really exciting technology, like, make sure you're using it for a reason, not just because it's the sort of technology of of the day. It looks like we've lost our moderator, but I'm sure we can model on.
Yeah, I'd agree. I think there are like many startups launching in those spaces, like Web3 or AI ML sort of, and like yeah, there are quite a number that are not differentiated, and I guess that's not, I say it's not a surprise, but also obviously not great. I wouldn't necessarily call it a bubble. But I mean, those are genuinely big opportunities and big spaces that are, you know, big enabling types of technology. So of course, you know, you expect a lot of companies to be built. I guess what's not super interesting is when you see startups that sort of just pick buzzwords and attach them to their business model, or you know, mention it in their pitch when actually the underlying technology isn't so strong or isn't really differentiated. So I think that's something I'd always sort of watch out for.
I think my approach on this is that the enabling technology is often the more exciting investment than the actual thing. So, for example, I'd be more excited about a platform for authenticating identity for crypto wallets rather than investing in a crypto coin, or, you know, we've done an investment recently where it's auditing AI algorithms so that when you know, self-driving cars make decisions based on AI data, or when X-rays are read by robotic doctors, it's auditing to make sure that those decisions are accurate. So I think, you know, understanding, like, if your thesis is that crypto is going to grow by X, or if your thesis is that these industries are going to be revolutionized by AI to this extent, you know, what has to be the enabler? Like, what companies are going to provide the kind of piping and undersitting platforms to that? I often think that's kind of more interesting, because I personally find it quite hard to pick a crypto winner. And I think often there's a little bit of just kind of putting your hand in the sky to work out which one's going to win. But the underlying platforms, the underlying technology has some kind of fundamentals to it, and has some, you know, thinking about why might this solution be what the industry adopts, and is often overlooked by founders, right? In the race to create the latest cryptocurrency, you kind of overlook, you know, what needs to be in place if your thesis is that crypto is going to replace fiat currency, you know, as the world knows it today. So that's how we think about investing in those two spaces.
Hey, I'm sorry, y'all. I hope you can see and hear me again now. Not sure what happened there.
Yep.
Still freaking out at me. But jumping back to the Q&A, I think we've covered pretty well those questions regarding AI and crypto and the like. So let's jump back to our list here. I would love to know, you know, what kind of situations do you see? I think we talked about venture alternatives a little bit. We talked about how the industry is changing. What are some circumstances in which a founder might not want to look for VC funding, and when that might be the wrong choice for them?
Yeah, in my opinion, I really like the concept of a business angel, right? So giving as much value as possible with kind of little checks. And I think that all VCs should kind of keep this mindset. So I think that founders should really look into this concept. And yeah, I mean, we're thinking about kind of how to scale our ticket at the same time. The kind of operational support that we're giving into the portfolio, it's aligned and it's not going kind of, hey, I have my value in the ticket size, right? So I think that founders should just kind of keep looking into this concept. And yeah, I mean, having something like very aligned with the LPs as well. So looking for a VC fund that also kind of includes the LPs on the operational support that you can just receive as a founder is quite important as well. So I would say it's 2 points.
I would say on that, Wade, I would say that 4 out of 5 founders should not take any VC funding, right? Like, if you look across the UK in terms of like successful companies that make money for the founders of those companies, right? That is kind of owning a local plumbing business, or, you know, building, you know, the local electrician company, or building a series of shops that expand from Edinburgh to the northeast of Scotland into England. Like, that's how you make money. And that's the majority of founders in this country, and how most value creation for individuals happens. if you take VC funding, it's because you believe that you're building a business that can generate VC returns, right? For a VC to invest in a company, they have to believe that this business has the potential to make 10x, 15x, whatever it is, and to be that one or two companies that comes out of, in our case, a university over the course of a couple of years that's going to return a fund. And I think sometimes it's kind of glamorous to chase after VC money, and everyone wants to kind of go after it, sometimes for the wrong reasons. Because if you're starting a business and that you think you can grow that business to something that's making 500 grand a year, £1 million a year, you shouldn't take VC funding. You should explore loans, other ways of financing that, and you're going to be much better off. That's how most people make their money. It's only if you think you're creating a company that is got that scalability built into it, that could potentially generate tens, hundreds of millions of pounds of revenue and be valued at billions of pounds, that's when you should go at that journey. You should go on that VC journey. But I think the saddest thing that we see is because VC now is this kind of financing mechanism that's got some kind of sex appeal to it, and people go after it that shouldn't. And foreclose on the opportunity of actually making a really good outcome for them, their family, and their staff by taking a loan or taking other financing, going on that VC track for businesses that were never going to be that £1 billion company. And the problem on the VC side right now is because there is such pressure to deploy capital, because there's so much money out there, because funds have got to deploy the capital raised from LPs, they're financing some of these opportunities they shouldn't be either otherwise. And so it means that the ecosystem right now, businesses are being funded that shouldn't. And again, I would estimate that across the UK, of people starting their own companies, 4 out of 5 of them are not VC backable and going to be doing much better if they call the British Business Bank or whatever else it is to finance it in a sustainable way. That means they're going to own 80%, 90% of that company on exit and have a really good outcome.
Yeah, I echo what Jamie said as well. I think if you can't be aligned with your VC in terms of the ambition, if you're looking to build a lifestyle business or one that is going to be slow and steady, profitable, and if you want to retain 100% control, then because of the power law and venture returns, it would be difficult for you to be aligned with your venture investor. And so venture investors are pretty much exclusively focused on companies that could generate really big outcomes, right? Or potential unicorns or 10, 15x type of returns. And so if that's not your ambition as a founder, or you don't want to give up control, then it's probably not the right thing for you. Or if you're working on a business that's really capital intensive and taking out a loan or debt, just revenue-based financing or other types of financing might make more sense, then yeah, VC might not be right for you. I think venture funding is great if you're building something that could potentially generate outsized returns, be a unicorn, or where more money up front in exchange for your ownership can really accelerate what you build and boost your end value and end outcome, right? But otherwise, it's not necessarily the best option.
I think we've discussed a lot about kind of venture fundraising from the founder perspective, and then for you from the firm perspective. I want to shift now to talk kind of broadly about the industry and ask where each of you think the industry is going to be in 10 years. We talked about, maybe there's a lot of money floating around right now. Maybe some startups are getting funded that maybe shouldn't be. And what do you think the effects of that will be when we talk about these venture alternatives? Where do you think that's leading us? I would love to know each of your predictions for what you think venture is going to look like in 2030.
I can jump in. So I think we're increasingly seeing a move towards impact investing and investing in companies that are specifically kind of looking to solve meaningful problems. It's there are huge challenges out there, and that's what sort of innovative startups and technologies is best placed to address. And yeah, again, sort of anecdotally, from 10 years ago when we were investing in tech for good, people saw it as really kind of, niche and on the edge. And over that time, it's just grown and grown and grown. And nowadays we're seeing sort of a new impact fund, be it an emerging manager or a spin out of an existing, mainstream fund launch almost weekly, both in the US and Europe. And yeah, I think it's a really exciting time. And I think the companies, the investors that aren't looking at that, increasingly going to come under scrutiny from LPs. And, you know, essentially every investment, every company has an impact. It's just whether it's a negative one or a positive one. And even, you know, even if you're pursuing positive impact, you also need to be understanding what your potential unintended consequences are. You know, these problems aren't going away, and people are understanding them more, you know, from consumers to customers to investors to LPs. So I think we're increasingly going to see a move towards, you know, impact.
Yeah, I can go next. So basically on the next, I think that on the next years will be, I mean, it's much more capital, like kind of accessible on the pre-seed stages, from very pre-seed stages. So I think that, yeah, that's the kind of like possibility to raise money is gonna be like very, very hard. And the thing that founders will just look for like more kind of smart money possibilities on the very pre-seed. So I think it's a huge opportunity coming here on the sector right now. Just a lot of kind of knowledge around there and a lot of capital around there as well. And we just need to kind of structure everything to make this this sector you know, bigger and bigger.
Yeah, I think, and also building on what we were talking about earlier, just I think there will continue to be more options for financing, for funding. We're already seeing them, like, you know, rolling funds of solo GPs or agglomerators, you know, like gigantic platforms, right, like Sequoia, Excel, Index, multi-stage funds, of course, you know, like Tiger, or the concierge type funds like First Round Capital or NFX. You know, those are, it's great to have that founders probably will continue to have a lot of these different styles and flavors and options to choose from. I think information is going to become more transparent. So with funds, both for the funds and for the startups. So funds, you know, are increasingly using tech and data to identify startups that they can invest in. And then there's also, you know, media, social media, where, you know, with Twitter, podcasts, etc., like information is just being passed, you know, around much more freely. And between founders as well, right? It's easier for founders to figure out which investors are great to work with, or what options are available to them. This will make the venture market, I think, more competitive, which means VCs are going to need to get better at being picked. I think the work here is increasingly about being picked rather than the VCs picking, especially by the best startups. And then I guess part of me thinks that with the valuations that are increasingly getting higher, there may potentially be some indigestions, right, in the next few years from late stage private companies going public, where public benchmarks, valuation benchmarks, may not be as generous as what we see in the private markets. And so, you know, there could be some challenges there for some companies down the line, but it's hard to see exactly, you know, where it's gonna hit. And then, yeah, like impact investing, like Millie mentioned, or backing the more underserved, underrepresented founders. Yeah, and I just think the pace of innovation and the number of, say, unicorns we're going to see coming out of Europe is going to be increasing at a exponential rate, as it has been. I think the last maybe 15 years ago, we had about 3 unicorns in Europe, and now in the last 5 years, it's been like 26. And so the numbers have just, it's like step change. It's not linear, right? So I think those are all sort of trends I think are going to be continuing.
Yeah, I would just add to what Cleo said and agree that I think you're going to see a correction, right? Both in the fact that public markets aren't going to necessarily stomach the valuations that are happening in private markets, but also just like markets are cyclical. And you know, for most people who are working in this industry now, sort of companies now, hasn't experienced anything other than boom times, and that just doesn't last. And so, you know, thinking as you build a business about how do you actually create value, how are you actually doing things that are resilient to the cycles of the market and actually genuinely needed by the customers that you're producing, that you're serving, I think are important questions. I also think it's a strong argument for making sure that you raise capital when you can, making sure that you've got the firepower that you need, and being aware that if you're building a business that might not exit for 5-10 years, you've got the strategy in place to raise capital as the market doesn't look as frothy and positive as it does now.
Awesome. Well, thank you so much, everybody, for all of your insight. We've got just a couple minutes left, and it would not be a VC panel if we did not have at least one breaking into VC question. So we've got a question in the chat. What would your number one piece of advice be for people who want to get into VC? And if we can lightning round this and get out of here on time, that'd be fantastic.
I can give two. I'll do a quick commercial plug. The number one tip is to join Creator Fund. So we've got teams across 28 university campuses. We take students with little to lots of VC experience. We love people with technical experience doing interesting degrees. They typically spend 2-3 years with us. They get carry in our fund, or they get remunerated on a cash basis for finding deals. And it's for us, we are training VCs young VCs that then go on to great jobs across funds across Europe. This year, again, 50% female at the senior level, and historically 35% Black and Asian minorities. So we're not recruiting right now, but we will be over the summer. Check out Creator Fund for that. And then the second thing I'd briefly say is don't be a generalist. Like, even if you're reading history like I did as an undergrad, don't be all things to all people. Work out like a sector or a vertical that you can really learn about and dominate. Become really smart on that. And then go to funds and say, hey, I can be your VR person or crypto person or agriculture person or whatever it is.
Awesome.
Yeah, I'd recommend, I guess, gaining some experience building companies, like either as an operator or a founder. That's probably best in terms of building empathy for founders or understanding what the journey's like as a founder. And then gaining actual experience in angel investing, maybe setting some money aside, doesn't have to be a lot, but just start writing small tickets and sourcing startups that you can back and really get a feel for the job and see if you'll actually enjoy it.
Yeah, I can really go next. I would say that the best way to go into venture capital fund is just actually create your own venture capital fund. I think it's the kind of best way to just earn a lot of knowledge and get a lot of knowledge in the fastest way possible. And if you think that is your long-term industry that you want to go for, I think that to start as a business angel and try to surround yourself with some experts, as Jamie and Cleo said, in different industries, I would say is definitely the best way to go into the industry.
Yeah, I don't have much to add to all of that brilliant advice. Can you hear me? Yeah, okay, cool. Wade was saying he couldn't hear me. That's fine. Yeah, I think, it's still, there's nothing can beat, good old fashioned sort of networking, but in a really genuine way, try and be really helpful to people, whether that's, sort of working with founders that you're really excited by. And also, talking about that, whether it's, sort of Medium, Twitter, or whatever, just kind of, be open about your ambitions and be helpful to people. Awesome.
Thank you, Millie. So here in our last 60 seconds, another quick lightning round. I want to ask each of you just for your parting words on if members in the audience, if you'd like them to get in contact with you, how they can do that, and if they can do anything to help you, what that would be. I want to thank all of you so much, though, for joining us today, both in the audience and on our panel. I think we've had a fantastic conversation about raising VC funding, some trends in the industry, and some common pitfalls to look out for. But if we can knock this lightning round out real quick, Jamie, could you lead us off?
Sorry, the question was how to get in touch.
How do you, if you want people to get in touch? Yeah, I know your email inbox is probably full.
Yeah, or even get in touch with me, or even better, we got getting in touch with the Creator Fund person on your campus. I'd imagine we've got someone on your campus across every university that Edventure's got a representative from today. Check out our website, they're all there, or check out LinkedIn. It's meant to be a really fun, easy first conversation for a founder with someone who's a peer of theirs, who's representing Creator Fund at wherever they go to university.
Yeah, I can go next. Yeah, definitely. So we are currently kind of increasing our operating partner network. So We're always kind of happy to talk with some industry experts. And yeah, we are also always happy to chat with later stage VCs that could be interested in some deal flow exchange sessions. So I will just share my email on the chat, and yep, let's get in touch.
I can go next. Yes, so you can, we've actually got a call for applications coming up in the next couple of weeks. So it goes live on the 24th of November. So if you're a founder with a really early stage venture or a really stage idea on how to use kind of tech addressing a big social or environmental issue, then we'd really love to hear from you. We hold open office hours and Q&As, and yeah, you can find out all of that information at bethnalgreenventures.com/apply.
Yeah, likewise for me, I'll put in my email in the chat, just Cleo at Stride VC. Happy to chat to any founders who are building exciting startups, or VCs who want to collaborate, be it early or later stage. So you can reach me there.
Awesome. Well, thank you again, everyone. Had been a fantastic time hosting this panel. I hope it's been valuable for our audience. If you'd like to get in touch with any of our panelists, there's some emails there in the chat for you. But that wraps up our panel on raising VC funding